Good afternoon, viewers. We have gathered this afternoon for yet another very interesting session on India's financial landscape. Like all of us know, India is a growing economy. It has been outshining most of the developed economies for more than a decade now. And we fundamentally believe that if there's one sector which fuels this economic growth, that sector is the financial services sector. And as you would know, very recently, our asset management company has launched a new product which enables our customers to leverage this opportunity. This afternoon, to talk to us about this interesting idea, I have with me my friend and the fund manager of this product, Gautam Bhupal. Gautam, thank you for making time this afternoon and talking to us and our viewers.
Yeah, thanks, Sabal, and thanks for having me here.
Gautam, you've been a fund manager for 2 decades, and with HSBC for more than about 15 years now.
Yes,
Uh,
16 years. Yeah.
16 years, great. So, Gautam, I'll start by a out of syllabus question first,
Sure.
Gautam. India today, I mean, how do you, as a fund manager, as somebody who is in the investments business, really sees India at this point in time?
Yeah. So if we look at India, we expect that in the coming decades, India will really stand out in terms of growth, and India will be one of the few economy which will continue to grow at a significantly faster pace compared to other large economies. If you look at India, India currently is the fifth largest economy, and by 2030, we expect India to become a third largest economy. And what we have see is that India, despite becoming the third largest economy, India will still be significantly smaller compared to, say, US or China, which will be the first and second largest economy. And that is where what we have tried to analyze is, or try to understand, that how long will it take for India to reach the size of, say, US economy, and we will reach the size of US economy by, say, 2046, 2047. And what we have also done is we have seen that in case of US, over a period of, say, last 30 years, their financial asset has grown at 1.5x of their GDP growth, nominal GDP growth. And we believe the similar situation would be in case of India also, where we expect that in the Indian context, the financial asset growth would be somewhere between 1.5 to 2x of the nominal GDP growth. So again, India will really stand out in terms of overall economic growth, specifically the banking sector or the financial services sector, which will continue to grow at a very, very rapid pace.
You spoke about financial services growth, financial assets going at a much faster pace than the overall GDP as well. Is that because of more wealth getting created, or is it because, especially in the India context, what do you think will really drive this?
Sure. So, firstly, we will see that overall financial assets growth would be significantly higher than the economic growth. Second thing, what we also compare how the wealth has changed within the US household, and this will give us some glimpse of what can happen in the Indian context. So, if we look at the US household, what we have seen that equities and mutual fund as a asset class, their share used to be 8.5% in the US household assets, say about 30 years back. And that share has increased from 8.5% to roughly around 25% currently. And this growth has happened across the income group, whether we are looking at, say, top 10% of the population or the bottom 50% of the population. And another very important point, which I would like to highlight, that for the top 10% percentage of the population, the equities and mutual fund asset has become the most dominating asset class in their household assets. So they have the largest share in their household assets. And they have even overtook the real estate, which used to be the largest asset in their individual household income. So that is something which is a very, very significant shift which has happened in case of US. And the ramification of this on the US capital market was that when we looked at, say, top 15, say, financial services companies, of the top 15 financial companies, say 30 years back, almost 10 companies used to be banking or lending companies, and 5 used to be the non-lending companies. And this has now completely changed. If you look at the current top 15 financial institute in the S&P 500 index in the United States, out of the top 15, around 11 are non-lending companies, and only 4 are lending companies. And if you look at the breakup of this non-lending company, this include credit card companies like Visa, MasterCard, American Express. You have a couple of insurance companies. You have wealth management and brokerage company. So it is again entire chain of non-lending companies which have really outgrown the banking system in the United States. And we believe that in the Indian context also, similar thing can really play out. And even if we look at, say, last 10-year history of Indian household savings also, we see some bit of this already playing out. So if we look at the Indian household savings, we have around firstly, financial assets has increased their share in the household savings from 41% to 46%. It has come at a cost of physical assets. And even if we will look at, say, equities and mutual fund, that used to have just 2% share in the household savings, that has now increased to around 7%. So in the Indian context also, we have already seen some of these trend playing out. But we believe in the Indian context, we are still at a very, very early stages of this trend. And we still have next 20 years where this will continue to play out. And again, equities and mutual fund will become much larger part of the individual household assets. So that is where we are really, really positive about the financial services sector in general.
So Gautam, two takeaways. One, you're saying that overall, US, if that's a reference point for us, then US savings has increasingly shifted towards equities and mutual funds, replacing real estate as an asset category. And you see India going in the similar direction. Of course, the time to get to an optimum level is perhaps somewhere still down the road, but that change is happening. The trend is taking place. The second, I think, is something interesting. You spoke about financial services and not so much about banks. So tell us a bit about because in India, banks have had a great run. So in India and in your context of this fund and the opportunity, tell us a bit about this difference between banks and financial services, and of course, talk a bit about banks in more details because that obviously is very close to Indians.
Yeah, so certainly, so when we talk about financial services, there are two main subsegments. One is the lending businesses, and second is the non-lending businesses. When we are talking about lending businesses, it includes banks, which include both public sector bank and private sector bank, and it also includes various NBFCs. You have diversified NBFCs, and you also have specialized NBFCs like housing finance NBFCs or microfinance or infrastructure finance NBFCs. So all these companies are lending companies because their business model is mostly driven about lending or giving loan to the customers and earnings the interest on that loans. Now we have another large segment, which is the non-lending segment. This includes asset management companies, stockbroking, depositories, exchanges, rating, insurance companies. So again, there is a very large subsegment within the non-lending space. And these are the segment where we believe that the growth would be significantly higher compared to the lending segment. We are not saying that lending segment will not grow. They will also grow. They will also contribute to the India's macroeconomic growth. However, the one main thing which we are trying to highlight over is that the growth in the non-lending segment will be significantly faster compared to the lending segment. And this is something, again, we have seen in case of United States, where if we look at when we gave you the example of the US capital market, where growth in the non-lending space was much larger, and they become the dominant part of the market. Similar thing will probably can play out in the Indian context also.
Interesting. When we talk about financial services in India, I think there are two aspects. One is the diversification. One is the scale. The other is the Gautam, I think one of the dominant features, especially over the last 10 years, has been this phenomenal rise of digitization, right? In terms of every aspect of financial industry, be it back office operations, frontline customer engagement, customer experience, journeys, and it has only made things easier. Now, many times, when we engage with financial services companies, we realize that is there too much of digitization? Have you really optimized this space, or do you see there is still a long way to go in terms of achieving maximal digitization?
Yeah, so this is a very, very interesting point, and this has been one of the major driver of growth in the overall financial services industries. So this has really improved the way the business or changed the way the businesses are being done. And there are a few examples like previously we have to go to banks to branch to do any transaction. Now everything can be done online. You have UPI, which has virtually replaced the cash in the Indian economy. So, and there are so many such examples which are there, which has been driving the change. However, another important point, which is specifically important in the Indian context, is the penetration of smartphones. So, if we look at currently, there is around 66% penetration of smartphone, and in 2 years down the line, we will probably have a almost 80% penetration of the smartphone in India. And second thing is that the cost of internet or data is one of the lowest globally in India. And hence, so anybody who can actually afford a smartphone can actually use the internet, and then they can do whatever transaction they want through their smartphone. So that is something which is a very big change which has happened in the Indian context. And that is something which will continue to drive. And another important factor which is driving this change is that Indian government has taken various initiatives where they have leveraged the technology and really created a backbone for the Indian financial services sector. But this is something which is not ending at any time soon. They have been continuously working on a lot of new initiative, like they are trying to working on something on the healthcare stack, which is there, which will immensely benefit the Indian insurance sector. And then there are so many other areas also they have been working. So the government is definitely, Indian government is definitely leveraging the technology in a very, very smart way. And that journey is still ongoing, and they are still continue to work on new initiative, which will continue to help the businesses to grow at a very good pace. So, so our journey is still ongoing, and we will continue to evolve in the digital space as we are going forward.
Interesting. Do you think there's much more journey to cover and things will get even better from here as financial services industry digitization even more? I of course wanted to also talk to you a bit about valuations, but before I get to that question on financial services valuation, I've got a question on the message board which has come in, and Gautam, I'll sort of ask this question to you. The question says, is it a good time to enter markets considering valuations and markets are poised to correct even more? What's your sense? Is it a good time to invest at this point in time?
So let me address the valuation part. Specifically, if you look at the financial services sector, this is one sector which is currently trading at a very attractive valuation. So if we look at the current valuation of financial services index, it is one standard deviation below its historical average. And this is at a stark contrast to a lot of other sectors which has been trading at a premium and which has been trading at a valuation which is above the historical average. So this is one sector which is where the valuation is very, very attractive at this point of time, specifically in the current volatile scenario. And second, we have to also look this in the context of health of the financial services or generally the banking system. So though the banking system has not done as well as some of the other sectors in say recent last couple of years, but generally if you look at the health of the system has greatly improved. When we are looking at the asset quality, the both gross NPA and net NPA has been coming down. The slippages number has been coming down. On back of that, the return on asset for the banking system has improved and almost become double from 0.7% ROA to 1.4% ROA in last 4 years. Generally, if we look at the capital adequacy ratio, the banks are sitting in a very good capital adequacy ratio. So they have enough capital to fund the growth for next 2 to 3 years without raising any fresh equity from the market. So generally, the health of the banking system has been very significantly improved over last 3 to 4 years. And at the same time, we have a valuation which is still significantly lower than what we have seen over last couple of years, and it is trading below their historical average. So in this context, the risk reward for this particular sector is very attractive at this point of time, specifically in the current volatile scenario.
Gautam, so just trying to extrapolate from what you said, you're basically saying that financial services industry at this point in time look very attractive from a valuation point of view. It could be a good time to enter that opportunity. And if I were to extend that, would it be fair to say that in any such market situation where there is rapid correction, there are going to be individual opportunities, individual sectoral ideas which would become attractive. And as an investor, one should basically speak to an advisor to understand where that opportunity lies and invest. One of the opportunities, of course, like you said, financial services could be one of such opportunities.
Definitely. So what we believe that when we look at from the fundamental perspective, nothing much has changed from the Indian market. The only concern was that valuation was slightly on a higher side, and which is also now correcting. Though at an index level, we have seen around, say, somewhere between 15 to 20% correction when we are looking at mid and small cap, and around 10 to 15% correction when we are looking at, say, large cap. But at an individual stock level, the correction is much sharper. And after those sharp correction, those stocks and some of these segment has become really attractive from the valuation perspective. And when we invest now, looking at 3 to 5 year investment horizon, this again would be a very good entry point where we can leverage the current correction and build up on our wealth or asset or equity portfolio or the mutual fund portfolio. So we are very constructive on the market, and this correction should be taken as an opportunity, in our opinion, to gradually increase the allocation towards the equities and the mutual fund as we are moving forward.
Sure, Gautam. And since you spoke about the financial services industry outside of banks as well, and you mentioned insurance companies, investment companies, wealth management companies, booking houses, and so on and so forth. Specifically on insurance, I've got a question to say, can you throw some insights into the insurance market as an investment opportunity? Any specific sort of ideas that you can discuss with us?
Definitely. So if you look at insurance sector, currently, if you look at the penetration of, say, health insurance, so India, if we look at the total medical expenditure which is paid in India, out of that, almost 2/3 of the medical expenditure is paid out of pocket by individuals themselves, and insurance companies pays only 1/3 of the total medical expenditure. And this is at a stark contrast with, say, China, where the ratio is almost reversed. And even if we look at, say, other developed economy, insurance companies pays 80% plus kind of medical expenditure, and individual only pay less than 20% of the overall medical expenditure. So this clearly indicates that there is a significant underpenetration of insurance in India. Even if you look at, say, life insurance, India only have around 3% life insurance coverage compared to, say, double-digit coverage for most other developed countries. So insurance is one sector which has a significant underpenetration in India. This sector again has not done as well as some of the other sector in last, say, 2-3 years, and that was mainly because government made certain changes towards the tax regime, and where some of this product become slightly unfavorable from that perspective. But that change is largely behind us, in our opinion, and this has already now been reflected in the lower growth of these companies over last couple of years. And given the overall underpenetration, we believe that again this sector is poised for a growth in the coming years. And again, because of the lower growth in last couple of years, again, the valuation of this segment looks very, very attractive in our opinion. And so again, from the risk reward perspective, this again is a very good segment to look at this point of time.
Gautam, interesting. I think you talked about valuation, and the opportunity insurance provides, especially the bit of a slump it saw after that announcement. But the opportunity remains to be a good one as more India insures, if I could say that. And two interesting questions coming side by side, both on the chat box. I'll ask both of them together. One, of course, is I think the portfolio seems to be suggesting that there is going to be a fair allocation into small and mid caps as well, as part of the overall portfolio. So would want to understand a bit more. Is there a percentage decided? What will really drive that allocation? And the related question, Gautam, of course, is that given the current state of the markets, one of the obvious questions that comes in is that how will deployment work? Are you going to be raising the money now because mid Feb and Feb, we have the entire money garnered? Are you going to be waiting a while? Is there a plan as to how the deployment will take place? So sorry, two questions related in many ways. One, small cap, mid cap. How do you see allocations? Two, of course, is overall deployment. What's the plan around that?
Sure. So let me take the second question first. So if we look at the timeline for deployment, the NFO is closing on 20th Feb. So we will start deploying the money from the last week of February. And we will deploy the money, 80% of the money in 1 month's time, because that is the requirement. But we can keep the balance 20% and deploy it over a longer period of time. Even X of this thing, we believe that the current market has corrected a lot, where a lot of these companies are now trading at a very, very attractive valuation. And secondly, as I said, that if we look at the overall index, specifically the banking side or the insurance company, they are already trading at a very, very attractive valuation. And even in the recent correction, they have not participated in the downward movement or drawdown because their valuation was already at a very, very attractive level. So we can easily deploy a large part of money or whatever allocation we intend to do in those set of sub-segment. So from that perspective, I think deployment will not be a major issue, because you already have a valuation which is attractive for the overall sector, and there are quite a few segments where we can easily deploy. And still there are some segment where the valuation has moved up over last couple of years, but there again we have seen a significant correction, and we will able to we can be actually take this time where the prices have corrected and get a good entry point in those companies or those segments, and hence we should be able to deploy it more prudently. So we believe that the current market correction actually has provided us a good opportunity to deploy the money at a very, very attractive levels. So that is how we are trying to deploy our money. Coming to the breakup of large, mid, and small cap, so it will be before I come to that, let me also explain overall portfolio allocation. I talked about both lending and non-lending segment. So if we look at the lending segment, they are largely large cap heavy, where most of the companies are or weightages are skewed towards the large cap company sector or large cap segment. And hence, whatever allocation we will do, it will be again skewed towards large cap in our portfolio also. But if we look at the non-lending segment, they are more evenly distributed in terms of large and mid and small cap. And that is where when we are trying to deploy our money in the non-lending segment, you will have a significantly higher proportion of mid and small cap companies in the non-lending segment, and hence our portfolio. As I explained earlier, that a non-lending segment is something which we are looking which we are very excited because of the growth opportunity in that particular segment, and hence we will be significantly overweight versus a benchmark. So benchmark currently have, or BSE Financial Services Index currently have around 18.5% weight in the non-lending segment. we will be significantly overweight, somewhere between 30 to 40% in the non-lending segment to start with. And hence, our allocation towards the mid and small cap company would be higher than what you see for the benchmark. So again, if you look at the benchmark has around 76% weight in the large cap and around 24% weight in the mid and small cap. Our portfolio would be more evenly distributed because we would be significantly overweight on the non-lending side, which again is slightly more dominated by mid and small cap compared to the large cap.
Interesting, Gautam. I think, but great deal of clarity in terms of why you are investing and why caps may not play a role is the overall strategy which will really play out. So and that within that strategy, a particular kind of entities might rest in the small and mid cap opportunity, and you would really invest to capture that growth drive there. A number of questions which have come in here, but before I come to the questions on the chat box. You spoke about opportunities, of course, more at a market level, but are there one or two, examples that you would want to share with our audience for us to understand what kind of growth opportunity exists? One or two entities that you really look at very carefully at this point in time.
Definitely. So let me take the example of, say, mutual fund industry itself. So if we have seen that mutual fund industry AUM has grown at 21% CAGR in last 10 years. So it is a very, very impressive CAGR. But still, when we look at the share of mutual fund in the individual household savings, they only currently represent 5% of the household savings. So again, and if you look at the, say, number of mutual fund investors, currently there are only 5 crore mutual fund investors out of the population of, say, 144 crore. So still, despite a very significant growth, which we have seen over last 10 years, still there is a significant under-penetration of mutual fund in India, and there is a huge scope for growth over here. And what we also try to do is we try to do some kind of projection into how the Indian mutual fund industry growth can shape up. So even if we assume the Indian nominal GDP to grow at, say, 10% CAGR over, say, next 5 to 6 years, and even if this household savings, which is currently at 5%, mutual fund share of household savings, which is currently at 5%, increase to, say, 6%, then even the annual inflow into the mutual fund industry can double from, say, $30 billion to around $70 billion. So there is a huge scope where the current inflow which we are seeing in the mutual fund industry, which again looks very, very large in the current context, because historically that number used to be relatively much smaller. But if we look at from the individual household savings perspective, there is a significant opportunity for this number to grow at a very high pace. Even over the next 5 to 6 years, it will probably become more than double, in our opinion. So we still believe that the overall industry growth will still be very significant in the coming years. And hence, we remain very, very positive on the entire ecosystem. So this includes mutual fund, but it also includes stockbroking and depositories, etc. So this entire ecosystem will grow at a very, very healthy pace in Indian context. Second example which I can give you is the case of, say, wealth management businesses. If we look at India's population, the growth is much higher in higher income group compared to the middle and lower income group. So currently, if you look at the household with income of, say, $35,000 and above, they are currently only 2% of the overall Indian population. But they will become almost 7% of the population by 2031. So the growth in that particular segment would be significantly higher. And again, if you look at the ultra HNI category, Indian ultra HNI population will grow at, say, around 60% in next, say, 5 years, compared to even global average of around 29 or 30%. So India higher income group or India HNI population will grow at a significantly high pace in the coming 5 to 10 years. And that is where services of wealth management companies will become very, very prominent. And they should be able to grow their businesses and they grow their AUM at a significantly higher pace in the coming year. So this is again one segment where we are very, very excited about the growth. I've already talked about the insurance segment. Let me also give you an example on the lending side. If you look at current budget, government actually has highlighted an increased focus on the MSME segment. Government actually launched an Udyam portal about 8 years back, 8 to 9 years back, wherein MSME can register themselves, and after doing that, they can actually access the formal channels of credit. So currently, we estimate that there are around 7 crore MSME in India, and out of that, already 3 crore has registered on that particular portal. However, in the current budget, the government has tweaked certain norms so that more and more number of MSME can register on the portal, because there were certain norms which are becoming a hindrance, and government has kind of tweaked those norms. So once, even if we look at the current 3 crore MSME, their overall credit requirement is around 140 lakh crore. And out of that, only 35 lakh crore is met through the formal credit channel. So there is a huge scope of growth on the lending space for the MSME, and there are a lot of NBFCs which are focusing on this particular segment, and hence they can grow their credit book in this segment at a significantly higher pace. So that is again one area which looks very, very attractive, where the growth can be significantly higher for those companies which are focusing on this particular segment. So these are some of the examples where we see a significant growth opportunity compared to the rest of the market.
Interesting, Gautam. And whenever one invests in equity markets, of course, one of the considerations has always been volatility, especially in the short and medium term. Of course, long term, we know that Indian equities, of course, have been able to provide much more consistent returns than any other market. But in the short and medium term, volatility remains a key concern. And I think one of the questions that I'm getting on my chat box is around volatility. It basically says, how volatile is the Indian market in relation to US, and especially in the context of some of the possibilities of what Trump could really announce. What's your take on that, Gautam?
So volatility is definitely a part of parcel of the equity market, and the same is true for the US and same is true for the India. So that is not something which has changed in the Indian context, and that is unlikely to change. But the moment you look at, say, longer term investment horizon, that risk come down substantially. So the biggest way to diversify this risk of volatility is increasing the investment horizon. And that is where we believe an investor can just keep doing the investment and keep investing from 5 to 10 years perspective, and all the risk of downside from the volatility will largely go away. And that is where our advice generally has been that just invest into the equity market from the longer term, and all this volatility concern will go away. And second advice is that SIP is a very great way to invest, where it automatically takes care of this volatility in the market. So these are the two things I can highlight, that volatility will always be part of the equity market. The growth in the equity market is never a linear upward movement line. It will always be a volatile scenario. But there are two ways one can tackle the volatility. One is the increasing the investment horizon. Secondly, investing through a systematic way, where SIP is one great way to do that. So these are the two ways one can minimize the volatility and risk associated with the volatility.
Sure. Sure, Gautam, one of the other ways that one looks at playing the volatility or playing the broader market is also index funds. Gautam, what are your views? Is index fund a good instrument to invest in, especially in the current market environment?
So our view is that India is still a market where active asset management play a very great role. And if you look at the performance of active funds versus index fund, we still have done, or active fund in generally has done better than the index fund over a longer period of time. And this is despite the fees which is being charged. So it is net of fees. So generally, in Indian context, we still believe active funds has a very great role to play versus the index fund. And hence, we continue to believe that active funds are better suited for the investors compared to the index funds.
Interesting. There is also one more questions around ETFs. Of course, exchange traded funds have been picking up over the last few years, but I mean, do you see them to becoming more relevant to investors, especially if liquidity in ETFs is it becomes better? Do you see them to become a more potent instrument?
Yes, so definitely ETF within the passive category, ETF can become a much larger overall, and this is something which we have seen in the US context also. So generally, I do believe that ETF will gain a larger pie of the passive fund as we are moving forward, and this will happen mainly because the liquidity in the ETFs, as the liquidity in the ETFs improves. So definitely ETFs has a role to play, even index fund has a role to play. But generally, again, I believe that active strategy in the Indian context would be still be more relevant compared to the passive funds.
Interesting. Interesting. Gautam, I mean, one of the questions that I'm going to see here and from the viewer is that major growth is coming from mid and small cap, but looks like these caps do not have much allocation. I think Gautam addressed this question a while earlier when he was talking about how this allocation shall take place. Just by the nature of companies that Gautam is looking at, there would be opportunities in mid and small cap. And I think allocations will really depend upon what that opportunity looks like rather than the segment that the stock really belongs to. I think that is broadly what the strategy would is. So Gautam, I'm answering on your behalf. So that's
Thank
how
you.
how that approach would look.
Correct.
I have an interesting question, Gautam, and since you are the fund manager and you spoke about alpha, this question is about you. So I'll read out verbatim. It says, "Hi, Mr. Gupal, lovely talk. As an investor, I wanted to ask what information flows you use. So what newspapers do you read? What is your favorite newspaper? What tools do you use, like a Bloomberg terminal? What are your data sources? Do you buy information from external sources like Bernstein? So your investment secrets, Gautam, you got to be out with them."
Sure. So when we evaluate companies or generally look at the market, so there are various data sources which we use. Firstly, we have a team of large research analysts, and we have a daily call with our entire team where we discuss whatever has happened in the say last previous day or last few days, and anything important is being discussed where we not only discuss the news, we also analyze what could be the impact of those news. So we have again, that is something which really help us in our investment decisions. Second thing is that we also have access to various sell-side research reports. And again, a lot of these are of very great quality where they again also analyze and the various companies or what is happening in the overall market and give their views of what could be the outcome of that and how it can impact the market or individual company. So that is again one another source of data or information. Then we also have access to data provider like Bloomberg terminal is definitely there, which we extensively use. And then we also have corporate database tools also where we can access individual companies financial metrics for last 10, 15, 20 years. So we have a couple of those tools also available with us. Obviously, we go through what all the major newspaper which are there and all the major news article which has happened over last one prior day or previous day. So that is something again we definitely go through, and it is not restricted to newspaper. Generally, even nowadays, social media has also become more prevalent. So something which get highlighted in the social media, which has an impact on the market or from our company's perspective, we also try to catch that also through some of the tools. So these are various data sources or information sources. which we use for our personal and trying to use that in our investment decision.
Sure, Gautam. So a range of things that really come in and
Exactly.
provide you the inputs to really take these decisions. Gautam, we are coming to an end of this conversation, and I think it has been an interesting, a very very interesting call. Gautam, if I were to request you to summarize the idea basically behind this particular fund, and what would you want to highlight as two or three things that should attract an investor to invest in this fund?
Yeah. So if we have to summarize, firstly, what I will again highlight that we believe that Indian economy is growing at a very, very rapid pace. And we believe that India will stand out in terms of growth in the coming 10 years. And as India grows, the growth in the financial assets and the financial services sector in general would be significantly higher compared to the broader market or compared to the economic growth. And this is something which we have already seen playing out in case of United States, and we believe that something similar thing will going to play out in Indian context also. Another very important point is that currently, if we look at the valuation of this particular segment, the valuation is very attractive, where the financial services index is trading at one standard deviation below the last 10-year average compared to a lot of other sector, which has been trading at a valuation which is higher than the historical average. So again, and the health of the system has generally improved. So from the risk reward perspective, again, this space really stand out. And third thing which I would like to highlight is the growth prospect, specifically in the non-lending space, where some of these segments like mutual fund, insurance, etc., they will become significantly larger part of the economy as well as the capital market compared to what is their size currently. And again, this is something which we have seen playing out in case of United States over last 20, 30 years. And we have no doubt that similar thing is going to play out in the Indian context over next 10, 20, 30 years. So this is again a space which will be a growth driver for the overall financial services sector. And in our portfolio, at least we are trying to differentiate our portfolio by having a much larger weightages in this particular segment, and this will essentially drive the growth for the portfolio, help us in creating the alpha for the portfolio. So again, so these are some of the points which I would highlight to an investor to keep in mind while investing in this particular fund.
Super, Gautam. I think I'll paraphrase: financial services, key driver of India's economy, valuations looking very attractive, long-term growth opportunity unquestionable given the low penetration. Financial services go beyond banks, so there are investment companies, there are insurance companies, there are broking companies. All of them provide a huge headroom to expand. And given the current volatility, good time to really start investing rather than staying away from the market. And also, I think what you mentioned earlier is in terms of the mix of capitalization, in terms of the underlying companies. There's going to be a good strong mix between large, small, and mid cap. So it in many ways covers a very large range of benefits. And we anyway said that equities over long term remain a very strong, stable investment class. Super. Thanks a lot, Gautam, for all your time and for taking us through this very interesting product. To all our viewers on this call, the HSBC Financial Services Fund NFO is currently live. It closes on the 20th of this month. Please reach out to your RMs. Please invest on your own. This is a great opportunity to begin your investment journey. And for any help, you can reach out to us. Any of our branches and our RMs will be more than happy to help. Thank you for giving us time and happy investing.
Thank you.